All right, so let's start with this. I've never been to a tabletop. Has everyone else been to a tabletop before? Okay, a few, but here's my sense. This is not a presentation. This is not flip the slides, check your email kind of thing. I think that we'll get benefit out of this if we all just kind of roll up our sleeves and ask questions. It could be a little rough, it could digress at times, but the idea here, as best I can discern, is we all want to have a look and a feel for what this is going to look like. So we know in our own swim lanes kind of what we're doing. We might know our next handoff up or downstream. But this is an attempt to try to get a bigger picture for all of us, to see what the screens look like, to understand the timing, the handoffs, the process. So it might get a little messy, that's fine. But don't think of it as a presentation. So if you want to, come on up closer, grab, all the chairs are open. But we're hoping for an interactive session in this whole thing, okay? All right, so Stephanie and I are going to lead the first couple steps. Let me just mention a couple things. I think that you could look at trades and dollar rolls and what we're about to do in a few dimensions. So certainly they have a lot of common themes and timing and elements. But within TBA trades and TBA dollar rolls, Stephanie is going to represent what it looks like from a Fannie perspective, if you have a Fannie position. I'll do the same thing from a Freddie, which will be a little bit more complicated. But then, maybe more importantly, we want to have the lens of all the different vendors that play a role in those transactions. So if you're not already up at the desk, I think we have kind of 5 or 6 categories of vendors. In kind of the data category, if you will, I see Jackie from Bloomberg, EMBS, Jean, great. Thank you for being here. The next category from data is trading. So I know we've got TradeWeb, DealerWeb with Brian. There's Brian, great. And Thomson Reuters, Don?
Is just on the phone.
On the phone, okay. Don, are you with us? Okay, he'll be joining us. So data, trading. The third group, as I see it, is kind of... Oh, good. Thank you, Don. The third group is portfolio systems, if you will. And in that group, we have BlackRock, Aladdin. There we are. And Charles River, right? Great. Thanks. Data, trading, portfolio systems. Next, I see pricing and index providers. So I know that some of you are in multiple categories, but we have IHS Markit at the desk. Thank you. And Bloomberg covers a few of these categories, right? And all this, as does JPM. And I don't know if JPM is in the room. Okay. Then where's Nick? Nick is the anchor to this lineup as FICC, netting, clearing, and all matters relating to FICC are important. And then finally we have what I'd call, I guess, well, I guess I covered it already, pricing and index. We got everybody represented. So is there anybody at the table I didn't call out? And then the honorary guest from SIFMA, Chris, keep chewing, Chris Killian from SIFMA, which is a good segue to something that I think it's maybe implied, but I want to make it explicit in all of this. So what we're talking about is creating one big market out of Fannie's separate Fannie and Freddie TBA markets. A very big part and a critical part of all that is good delivery, as is adjudicated by SIFMA. So let me read this comment, and Chris, let me know if you're good with it. The objective is a single security, one unified fungible TBA market between Fannie and Freddie. A key element of fungibility is the general acceptance that Fannie UMBS and Freddie UMBS will be treated as good delivery under SIFMA's Standards and Practices Guide, Chapter 8. I think that's where it is, right? Chapter 8? Okay. So for the purposes of today, we are going to presume that Chapter 8 is modified to allow for a UMBS contract to accept any combination of Fannies and Freddies. That is a process still underway. SIFMA is looking at edits. SIFMA has an official voting process that codifies all of this. That is still coming in all of this, still to be determined. But today, we're going to go into the presumption UMBS, good delivery, Fannies, Freddies, and that's where the work begins. Fair enough? Okay, thanks. All right, so with that said, I'm going to hand it over to Stephanie. And so as Stephanie describes kind of what Fannie trades look like, I'd like each of the people at the table from their different representations to think about kind of your screens, your role, your questions, and just kind of make this, make this whole thing feel like it's one big market talking to each other. So that's easy
Okay.
enough, right? Stephanie, you want
That's
to go?
easy. Yeah, we'll do that. Okay, so just from the Fannie perspective, I think, as Mark mentioned, it's a little bit more straightforward than probably the gold transition. I know on page 5, I don't have the clicker, but.
I do.
Okay. So on page 5, we did kind of lay out, and I think a lot of you have seen this before, where we have trades over the transition for UMBS. If you think about the Fannie, because, really the UMBS just mimics all the features of the Fannie, and essentially all the Fannie becomes the UMBS, that as far as TBA trading, in Fannies and rolling over the transition months, should be straightforward, right? You have, a Fannie roll on, you roll over May to June, you should just roll into UMBS. And I think, Nick, from a clearing perspective, all of that, it's O1F, so it all just sort of continues on and is able to net and clear,
Yep, exactly.
right, with no issue. I think the one thing, and this has kind of come up in recent conversations, is when you do have a roll on, a Fannie roll, that you're rolling from, March to April, April to May, May to June, one thing to think about is that when you roll from May to June and it becomes a UMBS, if you really desired only Fannies, you have to stip that when you go into June. Otherwise, you're going to have a UMBS roll, which could be filled with either Fannie UMBS or Freddie UMBS. So that is, I think, something that the market participants have to keep in mind as they get closer to the June launch date. That if they really have some preference for getting Fannie onlys, they have to stip that and make that clear. So I think that's just one little, nuance with the Fannie trade. And then I don't know how much we want to get into fails, but I know we've talked about, and I think there's been some discussion at SIFMA about, TBA fails. And I think, again, a little probably more straightforward with the Fannie security, that if you have a fail, what can you fill the fail with? And because Fannie is O1F and UMBS is O1F, you should be able to just fill it with either Fannie or Freddie UMBS. Is that still the consensus, Chris and Nick, or does it have to be a Fannie UMBS?
This is something we've asked members to give us their views on, and something that the TBA steering committee is going to make a decision on. But I think the choices are you fill a fail with whatever QSIP, whatever issuer you traded for.
Okay.
Or you go and do like I guess there's like 3 options, right? Like one is you fill it with whatever specific issuer you traded for. The other is like you said, a UMBS, which could be either. I think we have to take a view on that. I think there's complications to the extent you're filling a fail in a trade for one issuer with another that Nick maybe can talk about a little if I understand things right. But I think that's something that's another thing that TBA group will be kind of voting on.
So that decisioning will be made within that group
Yeah.
So I think, those are the issues. Even if O1F is O1F, it may be a little awkward to be filling a Fannie fail with a Freddie UMBS. So that sort of has to be worked out. And then I think, when we switch over to Mark to talk about a little bit more about the gold transition, we can bring that up again, how it's even a little more nuanced with the golds, because going into the transition month, gold is O2R, and then when we roll over, Freddie UMBS is O1F, so that becomes a little more complicated. But getting back to Fannie, so this is just meant to show, this is what this is trying to depict. I can't talk, I haven't had enough coffee. So this is just showing kind of the months rolling into June, right? So April, you sell May O1F, you buy May O1F, and then you roll into May, and you're still, basically this is just showing you that, the O1F is the Fannie MBS before June, and O1F is the UMBS after June. So there's really no change in the TBA QSIP. I think it would help maybe at this point, I don't know if this is the point where some of the vendors are going to show any screens, or are we waiting for that till like after you talk, Mark, or?
Let me step through it, because I think this will be a more
Yeah.
simplified version of what we'll get to with golds.
Okay. So I think just to, think about the different vendor roles is, data and analytics is Bloomberg. So, for the Fannie security, and Bloomberg jump in if I misstate anything, but, for the Fannie security, because everything is remaining consistent, that, as we roll into June, and just from a Bloomberg perspective, the prefixes are all following the Fannie, paradigm, so that the CL, in May is a Fannie, and the CL in June is a UMBS, and all that sort of carries over. So as far as, looking up pools, and, getting that data, the Fannie pools will essentially not change. I mean, everything will look the same from a prefix and CUSIP perspective when you're looking at the data. There will be some additional fields. There will be an issuer field that you'll be able to tell, if it was a Fannie or Freddie issued UMBS. And I think, and from the gold perspective, you'll have the mirror pools, and, Mark will kind of walk through that a little bit more. And then I just think, the pricing and trading, I think it would help maybe if TradeWeb just talked through again the months like rolling into June, because you're going to have this Fannie TBA market that you're showing, and then sort of June, it's like UMBS. So how do you show sort of those months, April, May, June, from like the TBA market perspective?
So do we want to do that now?
Or do you want to wait till the end?
Yeah, why don't we start showing screens? I think that's the meat of the,
Yeah.
of the topics here.
Sure.
Okay.
Thanks, Brian.
Okay. Hi, everybody. So on the left-hand side over here is our TradeWeb screens. What I'm looking at right now is in our demo environment, which means any one of you can go and take a look at this today. But like you were saying, what we've done to help facilitate this and to help people test is kind of simulate this transition as if it were going on today. So what we plan to do... I don't know if they can see the WebEx.
So the people on the phone are not going to be able to see all these screens that we're showing live, and I apologize, but we are filming this, so we will have them available in the recorded version.
Okay.
Thank you.
So in order, again, to facilitate this and to help people start testing this now, we've kind of simulated this environment as if January is going to be the starting month. And we'll continue to roll this forward so that people can test going out into June. But just from a highlighting point of view, we're looking at our kind of main page, the MBS 30-year page. And at the upper left-hand corner for 2.5s, what we'll do is we'll illustrate Fannie Mae / UMBS, and those prices and months that are in yellow will represent that that month contains UMBS. So again, just clicking on a price to bring up a ticket, it'll transition all the way through. We've already updated our descriptions. So starting at the top, underneath the buttons, it says you buy UMBS 30-year 2.5 Jan. And we will carry that through on all of our various pages. So for a roll, if I go back, in this case, the DEIS-Jan roll are Fannie versus UMBS. So we've distinguished the current month being still in the Fannie Mae mode. And again, this is really just a label change for us. It's very simple. It should process right through with zero work for anybody on the back end. And this will come up, and maybe I'm jumping ahead, but we plan to support the roll swap, I think people are referring it to, where you're going from a gold, I'm getting ahead of myself, but gold to UMBS from a May to June month. So we will support that. And just, I know that it's TradeWeb, but I can also speak on behalf of DealerWeb. Essentially the same exact thing. They are ready to go. It's very simple for them to put up any market that is necessary. So if there's some other transition type security that needs to be created, they're all ready to go with that. So same basic idea. They're going to carry through the 0NF, no changing in the nomenclature or the label values. We're just trying to highlight on the various pricing pages. For anyone that hasn't been in any of these tabletop exercises or is not fully aware of what's going on, we're trying to just map those yellow labels to represent UMBS.
Good question. STIPs.
Yeah.
Are there going to be STIPs that suggest 100% Fannie or Freddie?
I think the answer is yes. If what I'm hearing here, we have the ability to add that. So right now, what we're referring to is in our STIP dropdown, we have a whole bunch of options that people can choose. We actually support custom STIPs, but the plan right now is to add STIPs that would Fannie only, Freddie only, if that's what the market needs. So we're ready to facilitate that.
Just one question. Is there anywhere on the screen besides the label that tells you that it's a UMBS, not a Fannie Mae anymore? I may have missed that.
Just the label at the top. And we're trying to use just a consistent highlighting field on all of our various pricing screens. We didn't want to change the layouts dramatically. We've done that in the past, and our customers have gone bananas because they like to look at the same thing, same spot all the time. So we're going to try and keep that. We're going to use the highlighting for that. I'll pass it back off, or?
Yeah, that's probably a good start. Do we want to bring maybe the data teams into the
Sure.
discussion as well? Both Bloomberg and EMBS.
Do you guys want to show anything from the Bloomberg perspective?
Did you want to see anything like a specified pool, or do you want to stick with the TBA front?
What do you think, Mark?
Well, I think the change is greatest in the TBA space, not the spec pool space. So, maybe just a short answer of things are the same, that maybe a discussion of the timing of things. We're all very familiar with the Bloomberg cohort nomenclature, FNCL. So can you just, for the audience sake, take us through what FNCL means before and after the transition?
Sure. Right now, obviously, FNCL, TBAs, we use the nomenclature FNCL. That also, though, kind of plays into other things as well. The FN, as Stephanie was just saying, will still be used for, Fannie pre-June, and then UMBS post-June in respect to specified pools. And ultimately, those pools roll up to generics and cohorts. So any UMBS pool will still be a part of the FNCL generic or cohort family. So we'll, again, be retaining that symbology to encompass, all of UMBS, whether it be, again, Freddie issued or Fannie issued specified pools at that time as a result of those TBA trades in the beginning. So again, that'll be June, I guess June agency night when we update, being that exchanging will have happened in May. We would expect to see our cohorts then, again, the FNCL family of cohorts start to, again, have the Freddie 55-day pools included in them.
So let me go a little off script. Median speeds. Is there a timing and a syncing of when prepayment models kind of cut over? Well, does there need to be kind of a seamless or seamed change from FNCL on a Friday means Fannie, on a Monday it means Fannie plus 55-day Freddies? Will median speeds be clear that they're pointing to the right deliverable at some point?
Yeah, we'll be talking to the research teams that contribute speeds, and as soon as we see the TBA start trading, that's when we would expect to see those speeds being updated for FNCL collateral for June settle.
Okay, good enough. Okay, and then EMBS, I think, is in the room. Do you want to talk about?
I have two screens I can just show real quick.
Okay, great. I think Jean has some slides. So while we're setting things up, I think the thing that we're all just trying to get a feel for is, and if I have my calendar right, the last day of May is a Friday, June 3rd is a Monday. So what do we all have to think about over that weekend or leading into that weekend? So I would think most important is that when portfolio managers come in Monday morning, their positions read correctly in all of this. There doesn't need to be kind of an activity taking place so long as they know their positions come Monday morning. So I want to make sure that all the data that starts at the front end flows through all the trading systems, the pricing systems, such that people know their risk profile as soon as they show up Monday morning for all that. So let's just keep that in the back of our mind as we think through all of these different lenses to the market. Okay, it looks like for those on the phone, we have the EMBS screens up. Jean, you want to take it away?
Sure. So for the TBA's changes for UMBS, we've made a couple of changes. We've changed the agency from FNM to UMB for TBAs only. The product is also changed, and you'll see a table grid that basically shows you the prefix ID, the agency now UMB, prefixes are there, and then the product becomes UMB 15, 30, 10, 20, the market ticker, and the description. So those are the main changes we did for this, and then the following page is basically an example of a TBA screen. You'll see that it's no longer, it wouldn't show as FNM, it's UMB. The description is the UMB 30 year. So it's pretty much the same as the older screens. It's just that the UMB is now in there, and you'll notice the seller on the bottom is UMBS TBA as well. So this is a pretty straightforward change for us. I don't know if you wanted to touch on the mirror and gold screens.
Yeah, let's
Okay,
come
fine.
back to that in 10 minutes, but maybe for now, in talking with UMBS or EMBS in the past, there's a lot of making your product backward compatible and forward compatible. Can you talk about any of that as it relates to this transition?
Well, the files that we're getting, we are creating convert back files, if that's what you're referring to.
Yeah.
I think there's about 8 of them. There's 1 daily and 7 monthlies that we're working on, and they're in test right now. So I know a lot of clients have asked for when it's going to be ready because they want to start their testing. I would imagine by the middle of December we would have a good set of files out there. One of the things is because of the changes we're making, we don't want to give alpha files out and cause a lot of noise until we're in a better shape. So I think in the next 2 weeks we'll be ready to distribute those test files.
Okay, that's great.
Okay.
Yeah, thanks. Okay, so if that covers kind of data and trading, I don't know, Stephanie, should we think through the next couple steps, like the portfolio systems, the BlackRocks and Charles Rivers? Okay, yeah, so why don't you?
Did you want to show any of these screens before? Is there anything you need to show before we?
I don't think for the TBA side there's anything that's
Okay.
too different
Yeah,
from the other
I
vendors.
expect when we get into mirrors that there's going to be a heavy Bloomberg interest around what that looks like, what's in the system now, and all that. So maybe in 10 or 15 minutes. So do you want to take it away, Steph?
I mean, are we just going to move to the BlackRock and, Charles River to talk about sort of some of the changes, that their clients can expect? And I don't know if you guys have screens to share.
We don't have actual live demo.
Okay.
I think we have screenshots that are incorporated into the deck.
Okay.
If we can flip to those.
Yeah, that would be great.
Yep. So, so my name is Mike McMakin with BlackRock. So I can skip ahead here. We've got a few screenshots in this deck. I think, Jamie, will this overall be passed around to all participants, this deck here?
We can distribute
Okay.
that.
I'm not going to cover them all here, but in regards to the TBA trading, screenshots on this page here, and it's going to be a little hard to see. But there's 2 shots. The first one on the top left is really just what the UMBS TBA looks like. It's very similar to the Fannie Mae TBA behind the scenes, just that once that June go live date is in effect, the TBA will be labeled with the UM rather than an FN ticker. And we actually will have controls built into our system so that if you're trying to enter a TBA, we all have that go live date tokenized so that up until go live, so if you try to do it for May, it'll give you a Fannie TBA. Once you're into June and beyond, it'll give you a UM TBA. But yeah, behind the scenes, it's all the same. It's the 1F QSIP. They should work the same. The bottom screenshot on the right is a roll scenario. And again, this one's depicting the Fannie Mae in May rolling to a UMBS in June. So you can kind of, if you have good glasses, you can see the top one, the original settle date of the Fannie TBA is in May. The UMBS there, the bottom is in June. So we'll have that roll option pretty much just built into the platform if you have a Fannie roll on next to a UM TBA in June. What we don't have screenshots showing here, but we plan on building in also are further options for rolling the Freddie TBA, the FG TBA today. We will provide users with an option to actually roll that Freddie directly into a UMBS TBA once we get into June. So users will have an option of either rolling it to another Freddie TBA or a UMBS TBA. I think that's for, at least for this topic here, that's pretty much all we need to show. Any questions on that? Or?
I have a quick question.
Yes.
Same as last. What about slips here that indicate proportions of Fannie Freddie collateral? And does the same functionality exist in the mortgage browser?
Yeah, so the question, I'm not sure if the microphone's working there, but the question's on STIPs. Same question we had at TradeWeb. The first question was STIPs. Yes, well, so we do have the capability to support the STIPs in Aladdin for the issuer. I think based on TradeWeb's guidance, we'll probably also build in to our kind of standard STIPs dropdown, Fannie only or Freddie only issued pools. So we can add that in easily enough. Regarding the the mortgage browser question, the next question was, is this functionality built into the mortgage browser? Yes, so this is the screen that you would see directly in our trade entry screen, but presumably if you are in the mortgage browser application and arriving at this, yes, that's where the functionality is built in to either automatically roll a Fannie to a UMBS TBA or provide a user the option for a Freddie TBA of rolling to another Freddie or to a UMBS TBA.
So the browser will recognize if there's a STIP that indicates some proportion of Fannie Freddie collateral?
Yeah, so
when you
Aladdin's,
roll,
yeah, so we have the stipulations that you code into Aladdin at the time of trade entry are incorporated into our mortgage browser at the time of allocations. So when it goes and does the validation on the pools being received, it'll validate, is this a Freddie only or Fannie only, and give the appropriate warnings or errors as necessary.
Thanks.
And then,
Yeah. Any other vendors kind of in the space?
Yeah, Lydia.
Yeah, we need the mic there. Thanks.
Hi, I'm Vidya Guruju from Charles River Development. I'm the product manager for fixed income trading at Charles River. We've been working with Jamie and team for a while now, since beginning of 2017, I believe. A few different areas that we tested and validated. One is security setup of the UMBS itself. We use the mirror securities that were published, and Bloomberg actually enables us to pull those mirror securities down and into our system. That worked fine. We're testing that with some of the other providers, including our own data, Charles River, IDC, and Thomson Reuters. So no problems there. We did not actually have to make any changes because it's all the same fields. Next, in terms of the TBA setup and the roles, when rolling from a Freddie to a UMBS come June, we're expecting our users to sell their current TBA and buy the UMBS TBA in June. But if it comes to Fannie, it's a direct roll, May into June, so that's already supported. We didn't actually have to make any changes there. The key changes we had to make were in the area of pool delivery and taking delivery of pools, because 01F come June, or once they're available, 01F QSIPs will have to take delivery of not only Fannie but Freddie. Previously we had the restriction, we had to remove that restriction and test. The other area that a lot of our clients have questions about is compliance itself. So they have compliance limits set up for each Fannie and Freddie, separate compliance limits set up. Now that when they start trading UMBS TBAs, the question is, where does the exposure lie? Because it could ultimately result in taking delivery of Fannie or Freddie pools. So our compliance system is quite configurable, so clients can make a decision as how they want to proceed and configure the rules accordingly. The two popular solutions or approaches that clients seem to be leaning towards is one, combining their exposure limits between Fannie and Freddie and have just one exposure against Fannie/Freddie. The second approach seems to be to create a separate issuer ID for Fannie/Freddie. So they would have three issuers, Fannie, Freddie, and then Fannie/Freddie, and have separate exposures to each of those. So those are the main changes on our side for those clients who are not actually taking delivery of the underlying pools or making delivery of the underlying pools, which seem to be a majority of our clients in the current environment. They will actually not have to take an upgrade from us or take a patch from us. It'll all work seamlessly. But for those clients who are intending to take delivery or make delivery of pools, we are ready to issue patches for them. We are in discussions with multiple clients. But if you're just doing dollar rolls in the Charles River system, there should not be any evident difference that you see other than the name of the TBA come June will automatically flip from Fannie to UMBS for the 01 FQSIP. Any questions? And there was a question previously from Trader and BlackRock about stipulations. We have not actually accommodated that change. I think aware that you could specifically ask in stipulations once you start trading UMBS that TBAs that I only want delivery of Fannie or Freddie, but that should be pretty easy for us to make. But I didn't know that scenario existed actually, that somebody could say, I just want Fannie. I thought that the whole idea was that it's a single homogeneous pool.
That is the general idea, yes. But we want to be able to support what people need to be able to do.
Right.
But yes.
So if I could go one step further on the STIP question, because I know it's a subtext to a lot of discussion here. I think at least from the Freddie side, and maybe I'll ask Stephanie to weigh in from the Fannie side, the goal here is one market, but we don't want to preclude investors from their needs in all of this. So our recommendation is to the extent that we allow stipping in places now for all sorts of things, loan size, pools per million, geographics, there should be a similar accommodation for guarantor or seller servicer or anything else in that regard. But keep in mind what we're trying to do here is to merge the liquidity of two markets. And so, extraordinary efforts to kind of get back to two markets is not the objective of the project in all of this. And that's just what we have our eyes out for.
Yeah, I mean, that's exactly where Fannie's standpoint is on it as well. I think our goal is to not have the market overly stipping by issuer, obviously. If for concentration limits or however, investors are managing their portfolios, they need to, we wouldn't want to take away that capability, nor are we really in the business of doing that. But I think that if we've sort of set this up to try to minimize that and really truly combine, these markets into one. So yeah, I think we're all on the same page in that regard.
Great. And Nick, do you want to chime in from your seat?
Yeah, thank you. From the FICC perspective, we just want to remind our members that if it does start to trend more towards a STIP market, that none of those transactions would be eligible for netting. Right? And so now you're going to go back to more of a bilateral market, and I think we would lose a lot of the gains that we've made over the last year based on some of the things that we've done working with the industry. So, I mean, that's really, from our perspective, that's our concern, right? That we want to try to keep the netting possibilities alive and all the benefits that come with that.
Hi, my name's Matt Murphy. I manage our mortgage pricing at ICE. I just want to emphasize that once exchange activity begins, then we're going to provide those mirror prices, so you get those along with our exchange pricing. Our methodology or approach to this is that we're going to have the legacy securities linked to our UMBS prices. So if you look at the mirror pool versus its corresponding legacy pool, if you will, the difference in pricing, at least initially, will reflect the compensation. And I should note that our pricing reflects T+0 settlement, so there'll be some fractional differences in carry as well. But that's the crux of it. We're prepared, and a lot of our testing has been revolved around is planning for any contingencies that come about as a result of this, with regards to maybe the nuances to how the market may trade the legacy securities versus the mirror securities. So we're preparing ourselves for that. But initially, you should expect to see, from a pricing standpoint, the linkage, like I described, between the two securities.
That's great.
This is Mikey Spio, Broadridge. I just want to reiterate what Nick Botta from FICC was saying, that we've made a lot of progress with streamlining the operations, and in moving to a more stipulated land, that's going to create stress on the organization. So Broadridge will be providing the tools so clients can support the STIPs. But again, it's going to get a lot messier if we go that way. The teams are too streamlined these days to go back to 5 years ago, prior to the novation and all that. So that's it.
Market perspective.
Sure, yeah, we have some slides which we can pull up. Good morning, everyone. My name is Tom Marecki.
We can't see any slides on the phone.
We're not going to be able to show you the slides from the vendors. I apologize. We will have them as part of the recorded presentation, and we'll send them out after the meeting. All right?
Okay, no problem.
Okay.
All right. Morning, everyone. My name is Tom Marecki with IHS Markit. Just wanted to spend a few minutes this morning talking about our pricing product and process, and specifically the changes and diligence that we've done in advance of the launch of UMBS. So first slide, just very briefly, we provide 99% of global coverage across securitized products. You see our general breakdown of asset and a sub-asset class pictured here. But moving on specifically, of course, to agency pass-throughs more specifically, this is just a general overview of our pricing process and methodology. So starting with the reference data piece, of course, EMBS, who's here with us today, they are our primary reference data provider for pass-throughs. And specifically with regard to single security, back earlier this year in August, when the first mirror pool data was released by EMBS in conjunction and cooperation with the agencies, that information was made available to us and flowed through our systems, at which point we began our data QC and diligence process. So that primarily consisted of comparing the mirror pool data to the parent gold data. And we're relaying our feedback directly to EMBS based on our observations. Just going through the process, we then adjust our pricing at the cohort level based on trace information, client contributed trade data, and so forth, with our evaluator expertise and input into making those final adjustments. The next thing I want to just mention is our pricing engine, which is powered by Intex cash flows. Also, as everyone's probably aware, Intex has been publishing the cash flow models for the mirror pools. And on our end, we were able to basically validate those cash flows and see that they had been modeled in line with the, the Fannie-like schedule as opposed to the existing legacy gold schedule. Finally, our evaluations are delivered to clients through a number of ways: SFTP, through our PV or portfolio evaluation service, and increasingly popular, our price viewer front end. So in the next two screens, I just want to show how this information is currently being displayed on our web front end. So in this first example here, this is just the legacy gold pool of which everyone's familiar. You see the typical information you might expect: price, pay up, story, and so forth, as well as our liquidity score assignment. And in this slide here, you'll see that this is how an example mirror pool is currently existing on our system. So all 70,000 mirror pool CUSIPs that have been released so far, that information is available, and you can query that on our web front end here. Currently, in this particular example, you'll notice that the price is slightly different than that of the previous gold example, and this is because in this environment we've benchmarked this to the existing current Fannie TBA.
Okay, great.
All right.
Keep going. Is there, do you have more? Or?
That's it for today.
Okay. Because I think we're kind of naturally starting to weave in gold into this. And so, Stephanie, just maybe before we switch fully over to gold, is there anything more on the Fannie side that we want to
Well, just
touch
looking
on?
at the pricing is, and maybe this is just an obvious question, but when we sort of roll over into the launch of the UMBS, on day one, is the price of UMBS essentially just the price of the Fannie from a TBA perspective?
In our valuations, that will be the case on day one.
Okay. And then I guess with the mirrors, you said something about how you benchmark against the, like for a specified pool and looking at its price as you roll into June for the mirror. I'm sure it's more complicated than this, but when you said you benchmark to the Fannie, like a like pool, you sort of weave in the analytics on like a similar pool from the Fannie side to figure out the price on the mirror?
Sure. So in this example, we're just looking at the Fannie TBA and the pay up that we're assigning to the Fannie TBA.
Got it.
To clarify.
Okay.
Of course, as this market launches, and we'll see how these mirror pools are trading, then we can make adjustments if people are still benchmarking them to the legacy Freddie TBA or to UMBS. We can make those adjustments based on our observations.
Okay, thanks, that's helpful.
Okay, and I'll just open the mic if either Frank or Greg have any additional thoughts on kind of pricing and benchmarking and transition and all that.
So I'll start.
Your button. There you go.
Sorry. So I'll start. The only observation I have is I hear a couple of references to the May, June timeframe, but the reality is we trade the product 3 months ahead, right? So we'll see these observations and about pricing with the June TBA probably in March. So, I'm not against people thinking that as you get toward June, you're going to see more and more activity and you're going to see more consensus pricing. But in the end of the day, you're going to see this pricing probably March at the latest. From how the markets trade.
I think what I'd say is if you traded a June FNCL tomorrow, really what you're trading is UMBS. So, I'd say in essence, the way we're viewing it is, if somebody in theory wanted to trade tomorrow, that, the UMBS TBA is essentially live. That's what that June contract represents even today. And then in terms of pricing, I think we're taking a similar approach with UMBS. I think right now we're going to continue to plan to benchmark even the UMBS based on the golds, but I think that probably, and maybe as early as June 3rd, if not sooner, we'll at some point just flip that benchmark TBA for the way that we're capturing pay-ups over to the the Fannie stroke gold TBA, certainly as liquidity dries up in the legacy gold contracts.
Yeah, I would agree. Our marking of pools would be off the Fannie TBA mark. mark, not the Freddie.
Right.
The liquidity alone would be a problem. Never mind the fundamentals of the actual cash flows. I mean, the cash flows are going to stay the same other than the delay period. So we see convergence, right, toward the Freddie TBA mark today to the Fannie. Over time, that will be hopefully zero.
Yeah, we would just imagine perhaps there's some technical noise, during those transition months where somebody shorts something and that'll distort prices for a short period of time, hopefully.
Yeah, possibly. Hopefully not. Hopefully that noise is minimal.
Right.
Either way, the trader should mark to where the fundamentals are, not necessarily to the noise, right?
Right. Right.
Because ultimately, that's what the cash flow will generate.
Okay. Should we turn the page to the Freddie side? We good? Okay. All right.
Sorry, Mark.
Yeah,
Just,
go, Greg.
I'd say one more thing, in thinking about how prevalent, STIP TBAs are going to be. I mean, I think at least for those of us that are primary dealers, part of the TMPG best practices talk about orderly markets, maintaining, liquidity, supporting liquidity. So I think, if I'm thinking about this as a primary dealer, I don't want to do anything fundamentally that's going to harm the market. So, certainly I think that there's going to be investors that are going to want to trade STIP TBA, but I don't know that that's, and I think just to echo what some others have said, I don't know that we can foster too much of a move of that nature in a market, but I think we have to balance, providing liquidity in the way that investors need us to, and ultimately what the objectives of the broader market are. So I think that's something that's, generally I think going to be in our minds as trading patterns kind of develop, and what we decide to support.
So let me put something maybe in the parking lot at the end of the session. We're interested in metrics to some extent. Metrics mostly to see if things are working in places where we might want to insert ourselves. So I know that Fannie Freddie together are pursuing trace data, and I think there's some extra services we could buy. But we're also interested in the data that this room has, and what would be important to kind of get a bead on right now in kind of more traditional markets, and then monitor that as we move into this transition. So if you can, just start thinking about where we can get a good picture of liquidity, let me say, where it is today, and keep an eye on it as we move ahead. Okay? All right, so Jackie, if you don't mind kind of taking the next leg, what I'd like to do is we move into the Freddie side of the same discussion. Think about the differences that are happening in Freddie space. And mirrors are the big topic, exchange are a big topic. Maybe we can start again back at the beginning with how will that show up in the data services, the mirrors, the transition? Okay, all right. Jimmy makes a good point. We'll also be getting into mirrors when we talk exchange at some point. But let's then come back to the core session topic of trades and rolls right now. So let's do that in Freddie space. I think if we can go back, maybe it's just to the right screen. And let me start all the way again back with Nick. So the starting point for all this is how does TBA net and clear? Freddie today uses an O2R. Can I kind of hand it to you there, Nick, and take us through what that looks like as we progress through June?
You can hand it to me, but again, I'm going to take what my clients give to me.
Right, but so maybe it's just from your seat. Mm-hmm. Is it much of a change? Do your touch points need to be aware of anything?
Our touch points are not going to change. From our perspective, we're not necessarily looking at roles per se, right? We look at each individual transaction separately.
Right.
So if it's part of a role, I'm not necessarily going to see that. So the firms that are our members, as they submit to us, in May if they submit a Freddie Mac, and then June they want to submit a Fannie Mae UMBS, we'll see that under the different tickers. So again, from my perspective, it's kind of business as usual. It's really going to be away from us between the members themselves before they submit to us as far as what their intentions are.
Okay. And I don't know this answer, but is a dollar roll just 2 TBA trades in the way that you see it for netting and clearing?
Yep. From my perspective, again, it's just 2 separate TBA transactions, 1 month to the next. So.
Got it.
Yep.
Right. So not a big change there. Shouldn't have any kind of big downstream effect.
Correct.
The change is more now as we progress kind of to trading next. That's really where the subtlety and the importance of all this comes in. So I might bring our dealer reps here too. We got Frank and Greg. So as Stephanie described, if you have a Fannie roll on, it stays on, right? The one difference is you're going to have a different deliverable come June in our example. And so that'll be priced for effectively if there's a different expectation around speeds at that point. But other than that, it's very consistent. You were an 01, what is it, 01F indication before, and it stays that way. Not so in Freddie space. So you are an 02R designation for netting and clearing. April to May, 02R to 02R. May to June, though, it changes. So maybe we can see it through dealer's eyes. What is changing from your seats and all that? I think the term was introduced maybe by Brian about roll swap or swap roll. So are you thinking in that same dimension, or maybe take it from there, guys?
Yeah, I mean, I agree. What we're going to see is not a traditional roll, but more of a swap with a back month, drop, right? So it could be 1 month, it could be 2 months, but in the end, what we're going to see is closing out of Freddie Gold positions on a TBA basis. And for June going forward, you're only going to see the UMBS. So that generally is contracted in the roll market as 2 simultaneous transactions. The front month, again, could be a closeout of the Freddie Gold position. Unlikely, we're going to extend that to June. As far as we're concerned, we're not going to do any of that activity. We're only going to do it in June as a UMBS.
Is that right? Okay, that was my next question. So just for those in the audience, there's some question of, does the gold market cease come June?
From a roll perspective, yes.
Right.
You still could take delivery of gold pools, and we're certainly willing to do that.
Right.
But as a dealer, what we're going to do is, if we take the delivery of those pools, we're going to convert them into UMBS, right? Because we want the liquidity in the product, and therefore, from a hedge perspective or from a delivery perspective, we'll trade it as a UMBS on a deliver side basis.
Okay. So just to reiterate, your desk is not going to make gold to gold, May to June roll markets. That's the intention.
That's our intention.
Okay. Are you thinking the same way, Greg, at Citi?
Not necessarily. I think we want to, again, make sure that if there is investor appetite and or people have to close out shorts or whatever, that we're there to the extent we need to be. But obviously, I think that in terms of liquidity, that I like the term roll swap. It's a good way to. I think the liquidity in that as a trade will obviously start increasing. That's I think especially with it being on screens, that I think that'll be the main mechanism that people use for repositioning, and will have to manage. But I mean, I think that's probably not out of what we do in the normal course of business, between the 2 agencies or within the coupon stack or month to month. So, for us, that feels fairly business as usual.
Yeah, I want to be clear. We're going to offer liquidity to clients who want to exit the position, right?
Okay.
That's, we're not objecting to trading the gold product.
Yeah.
As an exit strategy. But what we're not looking to do is continue to offer a position where we'll deliver new gold pools into a client as no purpose as far as we're concerned. We have the ability to convert the pools, and again, I think from market transparency and from a liquidity perspective, to get the best economic price from our perspective, right, it would be to deliver the UMBS contract.
Got it.
Are there other dealers that have a perspective on this?
Well, let me loop Chris in, because I think and this goes back maybe a year. Oh, we do? Okay, good.
So I totally agree with what Greg and Frank were representing, right, going forward and how we plan to roll into the UMBS in the June cycle.
Okay. So I was just going to add, the conversation we've been having ongoing with SIFMA is, when a market ceases, is there some kind of point-in-time decision or announcement, or how does a market close out? And I think we assigned labels of, is there kind of a hard close or a soft close to it? And my sense was that more and more we're thinking soft, where if market makers don't put prices in forward markets, that effectively turns the lights out on forward trading and kind of TBA trading. But no one should expect kind of an announcement in any way. Should they, Chris?
No, I mean, we don't view it as our role to tell anybody not to do anything. So, I think it's just to the extent your traders want to make markets in these things, the market will go, and when demand dries up, it'll dry up.
Yeah, at some point we'll stop pushing prices, and it'll be, call, ask.
Right. Okay.
Yeah. And from an FICC perspective, if I have no pricing, then we can't take it for net, right? So similar to what the guys were saying, I mean, it almost would die a natural death, so to speak, right? As the trading activity dies down, there's no pricing available.
So let me go one layer deeper. Is it for a whole sector like golds? Or let's imagine if in production coupons there still were markets, would you keep those coupons only on net, or how would you think about it?
It would probably go coupon by coupon. I mean, it happens today, right? 15 years ago, we were doing Fannie Mae 10%, right? And slowly but surely the coupons change. Yeah. So it's kind of the same thing, right? That as pricing goes away, there's no trading, and it tends to die on its own. In some respects, we kind of envision the same thing happening here. So, there might be markets still being generated in some of the golds for the current coupons, but I think over time, you would start to see that go away.
Okay. That's great.
I mean, in theory, sorry, Brian.
Yeah.
I was just going to say, on the trading vendor side, we're going to support golds for as long as we can get prices from the dealers and as long as the market needs it. When we stop seeing that, we'll sunset it and take them off the screen. So there's no plans or hard cutoff from our point of view.
Okay. That's great.
Yeah, no, in theory, there's infrastructure supporting things like quarter coupons, but, nobody's going to trade quarter coupons. So
right.
I think, there's no compelling reason to shut anything down if there is demand, but that, it's just naturally going to wane over time.
Yeah, but the issue really is there going to be liquidity in the TBA market in the gold product, right? There'll be plenty of liquidity in the specified market, right? We see that until clients exhaust their inventory. I just don't see how there's going to be a liquid TBA market if there's no float coming out in the new marketplace. And that's ultimately, could you do it, I guess? Are you going to get a better mark than the UMBS mark?
Right.
I don't see it.
Right.
So the pricing disparity will widen between the two products if the market does exist, and ultimately investors make the decision whether they want to continue to trade something that's illiquid and probably get less accurate marks than they could if they just converted the activity to a UMBS. So okay. It will die a natural death, but the specified pool market will continue to exist until that is eventually dissolved.
That's good. That's a good summary. Before we move on from that topic, any questions about rolls, prices, screens, months? Yes.
Just from a margining perspective, due to pricing being a little unknown, how is SIFMA going to provide us some kind of guidelines during the transition of margining for the variation margin when we're moving into the new role?
I think in the current world, we don't have any recommendations on like VM or VM calculations or anything like that. So I guess if members wanted us to try to come up with something, we could, but we don't have any plans to do that.
I mean, if you have open trades on, that means that there's existing liquidity. I think you can always back into, in a world where there was no gold TBA, you can back into a gold TBA price vis-a-vis the UMBS price versus, you know, less or plus a generic flow comp. So, I mean, I think margin should be pretty straightforward and operate the way that it does today without issue.
To the extent we have activity with our clients and we see exposure, we're going to call you for that collateral, and we'll provide that mark against that collateral, right? And I think there's always a chance that the client has to say, well, they don't agree with the mark, and we work that out. But it's not that we won't provide the pricing if we have a position on with client.
All right, so I know we have Don up on the call. Don, is there anything from Thomson's standpoint with regards to price? And I guess the one topic I want to end on to maybe steer it a little bit is how are we going to think about prices and indices as we go through this transition before we close out this topic? So Don, do you have any views? Don, maybe you're on mute. Okay, well, we're going to be here for a few hours if Don comes back. Okay, you're not going to let off that easily. All right, so let me just leave it then with, I know we have some open topics with indexes we don't need to get into in this moment, but maybe the index providers.
I was on mute there.
I'm sorry, Don, is that you?
Yes, I was on mute.
Oh, good, good. Okay, can you back it up and play it one more time?
Yeah, so from our perspective, I think all the other participants have given an indication of pricing. Just from our perspective, we do expect to keep and maintain gold TBA pricing even after go live. We also expect that as new issuance comes in, that the market would thin out a little bit. So the concept still remains the same, that we would apply a float compensation discount from the new UMBS to get what the indicative gold TBA pricing will be if we're not seeing levels coming out of the market.
Okay.
As it relates to the spec pools, we've collected, and our screens already showing terms and conditions from as released by Freddie Mac. So you can see that in our icon products or in Datascope. So we're showing all the terms and conditions, but we're not applying pricing just yet. We expect to be able to run pricing over the next couple of months. But the standard methodology, we're following what Freddie initiates in the beginning, which is to, for the gold PCs, to match them using the flow compensation and any spec pool compensation to get to the UMBS pricing. We expect the initial pricing to stay as Freddie exchanges them, but will change over time as we see trades to trace or client. Any questions?
In the room, any questions? Okay, well, let's just finish out then on to hear from the index providers or the pricing services at this point beyond Don. And I think what you know, let me insert this thing. There's a dimension of information that Freddie will be providing that you all need to know about, which is how to price the deliverable as we start approaching June and beyond settlement. And a lot of that will get to, well, what is the deliverable? What's been exchanged? What's remaining? So we're going to put on our website and out to the market and to the data vendors to consume daily activity of what gets exchanged. So let me take an extreme example. Let's say that what's in Fannie deliverable now is of very high quality, and what Freddie's delivering is all cheapest to deliver in terms of exchange. Well, you need to know that. You need to price that You have to have a sense for the probability of that entering into your exchange or into your trades. So we're going to have something called an L1 report that helps sort that out, level 1. We're going to have some new fields that describe the proportion of pools that get exchanged. We're going to work with the EMBSs and the Bloombergs to make that more digestible so that people can more readily, in a moment's time, at least with a daily refresh, price what is in 55-day space at a cohort level for all of that. So that'll be another report. What I would suggest is think about now in your seat, and I guess I'm thinking from dealers, often we've used dealers through the box reports, their inventories, to basically try to understand, well, what's trading today? If I did a trade with you, what might I get in delivery? Is there anything more that you need from the market or anything more that you'll be producing yourself to help give a better view on what the deliverable is, which ultimately will inform pricing in all of this?
I think it's pretty straightforward. I mean, that.
I don't see that changing. I mean, I think what would be interesting to find out is how much actually did get converted at some point in time. I don't know if you're going to publish those stats, by percentage or by coupon.
Yeah, we'll be doing it daily. So we'll have the raw data. We'll have to figure out the roll-up that is of most interest to the market.
Yeah.
So, I'd imagine still your inventories plus our information will be part of how a trader would price deliverable in any coupon. I'm sorry, there's another view?
No, just to say that we expect that we've been told that you will be releasing the exchange amounts, and that we expect to be providing that to our clients to let them know the liquidity in any specific coupon.
So let me just throw a couple of questions out to the audience, which is, when you think about the deliverable, will you automatically presume 45s are part of what's a 55-day deliverable? Because, basically we're going to offer a 2-day process to turn 45s into 55s. Or will you treat those differently somehow?
I think it is different because there's a question of the people who have held to maturity accounts. So that essentially, there's a couple of different variations, right? If the collateral's in a deal, collateral's in some type of transaction that locks it up, and obviously held to maturity is an X factor. We just don't know.
Right.
When a client has it, is he holding it to maturity? Is he holding it for investment, to sale? But what would indicate some of that granularity is if we see 20% of the exchange market instantly happen, and that means we know that fact pattern, and then we monitor it. If it goes up to 50%, then we'll know where the market is trending and things like that.
Yeah.
So the action taken by the actual investor is, I think, important, because then it'll just be UMBS from my perspective. It'll just be UMBS going forward at that point in time.
Right. So I think for both prepayment reports and float, outstanding supply, we're going to try to give you components that then roll up to the total. So imagine, today, often in the first couple of hours from release of factors, we get Fannie speeds, Freddie speeds. What we would imagine post-June is there'd be Freddie 45, let me back that up, Fannie speeds, and then 2 pieces in Freddie space, both 45 and 55, that can roll up together. So what you'll want to compare, and I'm just anticipating people will say, well, wait a minute, I wanted my Fannie and Freddie speeds to be alike. Depending on how exchange comes in, you'll want to know, was there a skew or a bias to what got exchanged? Spec pools, cheapest to deliver, what came in most? And that likely you won't see 55, 55 Fannie, Freddie speeds on top of each other. But when you roll them all together, all the Fannies, all the Freddies, you'll see alignment in all of that. So what our intention is to give you the pieces, 45, 55, and combined total. And I just want to get other people's thinking if that makes sense from their seats. If you're going to do something similar to break it out, or are you just going to treat all the 45s as if they were converted and go that way?
Yeah, I mean, I think ideally if we're able to know, you know, for any given QSIP, you know, or at a pass-through trust level, like what sits in 45-day versus what sits in 55-day, then I think everything else kind of works, you know, works itself out.
Okay.
I mean, ultimately, and you know, I know we're not talking about exchange yet, but our expectation with exchange, right, is that anything that will be cheapest to deliver in gold, you know, that will be cheapest to deliver in UMBS is what's going to get exchanged from gold. So, you know, I think the expectation would be that we're looking at what's coming in, you know, prior to the settlement cycle, or what's out, you know, what's generally being, or what we think is going to be deliverable in a given month, and you know, that in theory should correlate with what we see or what we have seen in exchanges. So I think, you know, kind of naturally that mechanism should work itself out. I would anticipate. There's no, from my perspective, I don't see any reason why people should exchange unless they're going to deliver it into a TBA. So
makes sense. All right. So just this is more of a heads up. We'll start populating. At least show you what the format of those reports looks like. You'll know where they sit. And then as exchange begins, likely in May, we'll start populating that information so you can discern it all. Okay? I think that's it for this topic, unless there's any other comment or question before we close down rolls and trades. Anything? Anyone on the line? Okay.